First of all, let me start with France's AAA. What is the consequence if France loses its AAA, and should it lose its AAA?
Well, the market thinks it should, because if you look at their credit default swap spread, they're trading wider than a AAA would trade. I believe they're at about 225 basis points. Secondly, the two immediate consequences, one would be increased cost of borrowing for France. Secondly, and probably more importantly, the European financial facility, which is dependent on France as its second largest contributor, would face significant problems from that downgrade.
How many of these countries in Europe that have AAAs actually deserve their AAAs?
Based on the market information, borrowing costs, and credit default swaps, I would think that France is on the bubble, Belgium has already been downgraded, and the rest of them are trading within a range that would say at least they could be considered stable for AAA ratings.
I just want to come back to what you were saying about if we do see that downgrade of France and its own borrowing costs. You don't think it's already priced in the market? Do you think we'd actually see a further increase in French bond yields?
I think if you look at, I think there would be upward pressure. It may already be priced into the market. Certainly to move to 225, it's part of it's priced into the market. And I think that the bigger issue outside of France is still the facility and what the impact would be on how that facility would function. Can it function as it's intended to? And that's a big question.
How do you see this European crisis playing out? Do you think that the deal that they've just come up with is going to work?
I don't know if it's going to work or not. The market's very nervous about it. So the market is the real force here, and the market thinks they need the ECB to be the lender of last resort to the sovereigns as well as the lender of last resort to the banks. And until they get some clarity around that, I think we'll have a great deal of uncertainty.
You know, we've seen there was an interview with Mario Draghi in the Financial Times today, and he's been talking about the possibility, you know, we've got that 3-year loans coming up for the banks this week, and he's saying one of the options, of course, to the banks is that they could purchase sovereign debt. And we've seen big decreases in the yield on the 3-year Italian and also Spanish debt. Do you think that it's going to be an option for the banks to move into the market?
It is going to be an option. How much more they want to put on their balance sheets is the big question. So if you look at the decrease, it has been a big decrease, but they're still trading at 5, 6, 6.5%. The carry trade, borrow at 1%, reinvest at 5 or 6% for 3 years, makes a certain amount of sense.
Isn't that dangerous, though?
Well, it is dangerous, because what happens when 3 years gets here? And will that be enough time for the recovery, and are you going to be in any better shape? So it is dangerous. It's going to be appealing to some banks. Most of what we see is mixed. We see a lot of banks saying, no, we don't think we want to go there. We want to clean up our balance sheet and take a different direction. But obviously with the Italian and Spanish yields coming down on the 3-year especially, some banks are obviously considering doing that.
I mean, the danger obviously not. I mean, do you see the danger in a default in either of these two countries in the next 3 years?
There's a possibility for a default, sure. I think that it would have to get much worse before
an Italy or Spain.
Italy or Spain to default. And I think you'd see the ECB act radically differently before that would happen.
So you believe that the ECB may ultimately come in, step in?
I think if it deteriorates much further, they'll blink. They're not going to blink preemptively, but they'll blink.
Deetz, Managing Director at Navigant Consulting, thanks so much for being with us this morning.
Thank you.